Long gone are the days where you just buy any piece of real estate and you cash flow. Now you're basically cash negative if you do not know what you're doing in this market. I think that's going to breed a whole new type of investors, and looking long term, that's going to be good for our overall market. Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow. All right, you already know the drill. BOC pauses interest rates. Everybody takes a deep breath. What the heck's going to happen, and what are they waiting for? Again, you already know this happened. And so if you're watching this video, the goal of watching this video is to actually ask the question of, when the BOC pauses, what's likely to happen, particularly in light of, well, a little thing that's going on right now called a Canadian election. Now, stay tuned for this episode, because if you're interested to figure out what typically happens after the BOC causes and what are some of the things that most Canadians are not looking out for right now, then you're in the right place. Let's get into it and talk about what actually happened and what's going on. So first and foremost, the BOC paused interest rates at 2.75%. Y'all know that at this point right now. And well, this was all despite a weak growth outlook, rising job losses, and actually a pretty impactful amount of job losses that just came out as of a week and a half ago. Falling inflation, with inflation expected to be closer to 1.5% in reality, and the carbon tax rollback with lower oil prices. It was a really interesting decision the BOC made last week. And what I'm more interested in is, what is the fallout of that and where do things go going forward? Not just as it relates to BOC and variable rate mortgages, but overall in the real estate market. How does the market react to that? Now, if you're a mortgage holder right now, which most of you listeners out there are, or you know someone is, here's the thing. The BOC could have cut rates, but they didn't. And that speaks volumes about how cautious they are. What was really interesting, and I've repeated this a few times in different social media formats and in my last video, was they literally sat on the fence and said, we could cut rates, but we didn't. And things could go up or things could go down. It just felt like really just throwing things out in the air and saying there's a coin toss of a direction of where things could go. Let's talk a little bit about why they held back and what the BOC's reasons are, and then we'll get into what this means for you and how this could impact the market overall. First of all, core inflation at 2.85% is still quote unquote sticky. They didn't see enough of a drop in overall inflation to suggest that it made sense to cut interest rates right now. With inflation expectations jumping, there's a dangerous precedent right now for wage and price setting. Let's break that down for a quick second. There have been a few surveys that have come out recently, actually quite a few. And if you're not aware of this, BOC is not just looking at what's happened in the past, but what could happen. And a number of these surveys that have come out are specifically suggesting that consumers are expecting inflation to continue to increase. And some of the most recent surveys, I'm not sure again which ones they're referencing here, but I've seen quite a few out there. Some of these consumer surveys are referencing a huge increase. So looking back to just a few years ago when inflation was at 6-7%, consumers are now expecting inflation to hit those types of numbers, even though it hasn't happened yet. And when the average Canadian is expecting inflation to happen, it means basically that they've resolved the fact that this could happen. And basically it's like one of those things where if you believe it will happen, it will happen. What's worse here is that businesses in a recent survey suggested that they were also feeling the same way, which means therefore that they will pause on many hiring practices, they will pause on wage growth, they will pause on more investments in the economy. And so it's kind of like this back and forth game right now where consumers are expecting everything to go up and businesses are expecting the same to happen. And so they'll price accordingly, but they'll also be weary to hire in spite of these current situations and what's going on right now. With the upcoming governments and the uncertainty around the governments, I think the BOC is taking a pause and wait and see approach here, which they basically said with the fiscal stimulus expected to increase. Basically, they're saying the governments are going to spend money. And when that happens, obviously, this will stimulate the overall economy and can cause things to, again, increase if they do decide to spend more money. As you can imagine, that is another concern the BOC had in this whole picture. Supply chain disruption remains an inflationary risk. So obviously tariffs are real. And if things get worse there, God forbid that happens, we can see inflation continue to go back up. And last but not least, the risk of overstimulating the market right now is greater than the risk of easing too late. Basically, BOC said we're more afraid of what could happen than what is happening right now, which is honestly probably the biggest concern that I would have looking in the marketplace. Like, we're being afraid of what could happen versus what is actually happening right now. And if you look at the marketplace right now, all signs say that we are currently and have been in a recession for nearly 6 months in our country. If that is the case, and if that is reality based on what is considered to be a recession, then why are we sitting back and doing nothing still? Now, from a real estate perspective, like, what do you do? And what does this mean? Now, higher rates for longer could affect home affordability. We've seen home affordability go up dramatically over the course of the last 2 years because rates went from 6.5% to 4.5% or 4%, right? But of course, that could continue to hold the stress test up because fixed rates, although they went down for that brief 1 week period of time, they bounced right back up really quickly. And there's a lot to suggest that fixed rates are not going to go down anymore. They're going to stay where they are or going higher. And as you can imagine, lower rates equal higher affordability and higher qualification. If we're not going to see that, then that's going to impact the real estate market as well. And obviously, the implications of this are we see more and more Canadians who are happy and excited to see the rates go down 2.25% over the course of the last 7 rate cut periods. That stopped, which hurts real estate investors. It hurts people who are seeing their pre-sale condos completing right now, and so many more people who are considering getting them back in the market. Let's be honest, people wait on the sidelines, even whether the BOC market actually doesn't have any impact. The amount of text messages and emails that I receive that say, well, we're going to actually wait and see what BOC does before we lock into our rate or lock into our mortgage is a really interesting psychological consideration because, as you probably know, BOC cuts rates 0.25%. There's not a direct correlation on fixed interest rates. That's directly correlated with variable interest rates. But a lot of people also don't realize that if they wait, banks may choose the opportunity to actually cut back on the discounts they're offering on variable, therefore increasing the cost to the consumer. So anyways, it's just an interesting consideration on consumer psychology. I had someone reach out to me recently who said, Alex, before 2022, I never ever paid attention to what BOC did, and I had a mortgage for 10 years. Now it's like the Super Bowl of mortgages every single time, and he's watching all my videos and content. So interesting to see how that's changed a lot of the psychology of the marketplace. Okay, so let's talk about what actually happens after a pause in the real estate market. For historical context, now these are the stats. This is real. Not making this stuff up. Did the numbers here. Since 2000, the BOC has paused rates 20 times. That's right. So there's 20 times that they've gone down and paused in the cycle. Quite a few. In 50% of those cases, the next move continued the last trend, meaning they cut after they paused. So let's be more clear. In half of those cases where they paused, they cut again after that case. In the other 50%, they reversed course entirely and kept going flat, moved their way back up. So basically, it's literally a 50-50 chance based on history as to whether or not they resume course and cut interest rates or pause and reverse back upwards. So more or less, the conclusion of this is that a BOC pause gives us absolutely no clear indication as to what to expect, and we should not be looking at history to be making these decisions. In fact, they basically said as much in that meeting that they had no idea and that rates could go up or they could go back down. But here's what we do know. The markets right now are pricing in no more than 2 rate cuts in 2025, which actually fits perfectly with where a lot of the banks were predicting interest rates at the start of the year. So that would mean 2.25% overnight rate by the end of 2025. That's what the market is suggesting right now today. Now, Scotiabank expects the BOC to hold for the rest of the year. Scotiabank, notoriously speaking, has always been the most conservative. So if you're more on the conservative side, then you're typically leaning towards Scotiabank. If you're more on the aggressive side, you're usually leaning towards a bank like BMO to do that. So basically what that says is that if we follow what the Scotiabank, Derek Holt is the economist, the lead economist at Scotiabank, if we follow what they say, then we would see the overnight rate stay at 2.75% and most variable rate holders sitting between 4 to 4.5% for the remainder of the year, except for those who have previous rates between the -1 to -1 plus from back, 2021 and 2022. If inflation accelerates, hikes are not off the table, and they made that very, very clear. Now, it's an unlikely outcome that we do see these hikes accelerate, but the biggest wild card here is the reality of the tariffs getting worse. And with what's happening down south, I mean, honestly, at this point right now, who can assume that isn't going to happen in this current marketplace with everything that's going on right now? So, what's your mortgage strategy in a pause environment? Like, what do you do as a Canadian homeowner right now? And the real question for mortgage holders is, do I want to gamble on a variable interest rate in an economic standoff right now? And the answer to that question is kind of subjective depending on your strategy. But let's talk about the current rates on the chessboard right now. The fixed rates. Now, let's talk about insured borrowers. Now, as we all know, insured borrowers less than 20%. Who are buying homes or refinancing, switching their mortgages. Those borrowers are getting the best rates. You're going to see a 4 to 4.25% range. They're still available right now. There's still some sub 4% rates out there, but not many. And variable rates right now at this point are hovering around prime minus 65 to prime minus 85, depending on what types of things you're willing to give up. Some a little bit better, some a little bit worse. Again, these are insured mortgage rates I'm talking about. If you're taking a fixed rate right now, you're looking for stability. With the market basically projecting that fixed rates are basically going to stay the same or go up for the next 5 years, it's not a bad risk for a lot of people to do. The biggest risk associated with that is the prepayment penalty clause. So looking out for those prepayment penalties if things reverse course. Given what's happened the last 3 years, I don't think it would be a bad idea to put yourself in a flexible situation so that if things do reverse course, you are in a good position to be able to renegotiate those terms. The variable rates themselves currently project not a significant savings advantage and a higher risk, but always with a greater flexibility. So for somebody who just knows for a fact that they're likely to kick out of this thing in the next 2 to 3 years, but they don't know the timing, then a variable rate has a low risk associated with the prepayment penalties, but it doesn't offer the projection of a lot of savings today, at least not where things are at, unless you believe that the rate cycle will go down the extra 0.5%. Where we're seeing more people go is the hybrid mortgages, but the availability of a hybrid mortgage is somewhat limited. And so for that reason, we're not always recommending it to every client. We always look at it on a case-by-case basis. If you haven't already watched it, I've used this framework called Prepare that we deliver to our clients who are considering trying to figure out which decision to make in this type of a market. And if that's something you're interested in, just find me on Instagram at themortgagepug or at Flow Mortgage Co. and just DM me Prepare, and I'll send you this framework to figure out how to make your best mortgage decision. Right now, the current trend that we're seeing right now is interesting because it's flip-flopped from about a month ago, where 70% of Canadians are opting right now for a fixed rate mortgage. This is kind of surprising because I feel like my business is more 50-50 right now, with a lot of people still opting for variable. Now, recently the odds kind of flipped and they stopped favoring variables. So we're really looking at whether or not this is a long-term hold situation or what your circumstance is. We're seeing more and more of these situations make sense for those who are in a long-term hold situation where they're taking fixed interest rates, again, keeping in mind the conscious factor of those penalties. So bottom line is, like, right now, today, this could change in 30 days. Unless you're ultra flexible, you're strategic and emotionally bulletproof right now, it probably means a fixed interest rate is your friend at this current cycle. And the question that everybody else really keeps asking is, honestly, like, how does this impact the real estate market and where do things go at this point right now? Buyer affordability still remains stretched. Let's be honest. People are qualifying to their maximum capabilities, and the market hasn't really softened to the point that most are expecting. In fact, most recent real estate stats show that even though property values have declined in the condo market, every other market has increased year over year. Detached houses and townhomes and row homes across the country of Canada overall, by average, are actually up year over year, which might be surprising to many. And some are still calling for a crash, but that's what the market shows right now. What I'm noticing right now in the marketplace is way better choice. I mean, straight up, you just got more options to choose from right now, which means that you can negotiate terms, dates, things like that. But price points are kind of holding across every market except for luxury markets and condos. And I heard that same feedback in the Easter long weekend, where I talked to multiple people who were getting offers accepted, to say that, hey, it's not like we're getting these properties for 10% below list, but we are being able to negotiate different terms that are important, and we're getting properties that we never saw available a year or even 2 years ago. Real estate, in the effect of the BOC pause suggests that there's no real relief right now for variable rate borrowers, and the renewal market still kind of stings. We're seeing more and more people look to refinance and take advantage of the ability to consolidate debt in this market. And in addition to that, a lot of the investors that are out there are still facing a lot of tight margins, which is something we've talked about before, which is providing investors to be more analytical, but it also is giving them a little bit of an upside in the market where they have to be way more diligent, which is probably going to be better for investors in the long run, meaning that you have to be a little bit more clear on what your goals are and what you're trying to get away from in this market. Long gone are the days where you just buy any piece of real estate and you cash flow. Now you're basically cash negative if you do not know what you're doing in this market. And so I think that's going to breed a whole new type of investors, and looking long term, that's going to be good for our overall market. It'll get rid of the people who are maybe just looking at around and just trying to dump market money in the marketplace. And it's going to focus on people who are actually good landlords and good investors, which is good for the marketplace as a whole. Could demand soften with this rate pause? Possibly. Although a lot of people are suggesting that after the election, we're going to see people get off the fence and start jumping in, and we're going to see a late market. I don't know, but I'd love to hear from you. Do you think the market's going to pick up after that, despite the rate pause? Let me know what you think in the comments below. All right, so what should you be watching for right now? If the pause becomes a pivot downward, buying activity might pick up. I mentioned this before. If this is a pivot and then we see the downward trend, we could see a real rush back to the marketplace as everyone says, okay, we've seen what's happening. The election's over. Maybe the tariffs kind of chill out for where they're at right now, and we get back in the market. That would not surprise anyone in the least. But if rates rise again, we could see further pressure on sales prices, and we could see people jump back out of the market and see a complete pause and a stalemate for one more year before people have to start to really deal with all those renewals coming up in 2026. So, I mean, a couple takeaways here that really, before we wrap up, that you should be thinking about. Number one takeaway is if you're refinancing soon, a fixed is going to be the safer path, as we talked about, unless something major shifts. And you should always be aware in this type of market that something major could shift, and it is a real possibility right now. The next rate meeting is on June 4th. And right now there's like a 50-50 chance right now of a rate cut or not, which is basically what the market told us. And it's what the BOC told us at this point right now. The fixed or variable rate spread right now, I mean, fixed are still about a quarter percent cheaper than variable. The big reason that you're going to want to still consider a variable rate is the upside risk of the market continuing to go down and the flexibility that you're getting with those prepayment penalties at this point right now. Let's be honest, last week's BOC's decision wasn't just about holding rates. It was sending a clear message to the marketplace saying we're watching, we're waiting, but we're not ready to blink in this current marketplace. And whether you agree with it or not, that's what they did. And so we got to stick up with it. For borrowers, I mean, let's be honest, it's going to mean embracing this uncertainty in this market, especially in a market itself out of unknowns. I keep hearing people say this word, it's a weird market. Well, it's been a weird market for 5 years, so we kind of have to get used to it. There is no such thing as a normal market anymore. There are going to be bumps and bruises, and it feels like we're on this perpetual roller coaster where things never really bottom out per se, but they continue to go up and down and up and down. If you're unsure of whether lock in or split difference, remember, my team and I are here to help and support you. We are licensed in BC, Alberta, and Ontario, and are helping borrowers specifically to find better cash flow within their mortgage, whether you're an investor, you're self-employed, or you're someone who owns a property looking to figure out what to do in this marketplace. So if you enjoyed this episode, make sure to rate us and leave us a review on iTunes or Spotify. Greatly appreciate it. And we'll see you on the next one. Give us a thumbs up on YouTube too. Thanks, guys. See you soon. That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.